Hello friends, welcome back. Let us understand the definition of equity. Equity is basically the portion which is invested by the equity shareholders, who are the people who own companies. Technically, when you own the equity shares, you own the company. It is very simple. Let us say you pay for the Apple shares in the stock market. Even though you buy one share, technically you are the owner of Apple. The equity investors who contribute any money for buying the equity shares are generally called shareholders. In simple words, they are the owner of the company. In accounting, equity is very simple. Equity is the assets minus liabilities. As said earlier, equity is a simple definition when you have total assets in the balance sheet from which all the liabilities are removed in terms of the long-term liabilities, short-term liabilities, current liabilities, and non-current liabilities. What remains is the equity. Equity includes the people who own the company indirectly, and the owner of the company who takes all the risks. As the stakeholders take all the risks, their return expectations are always higher as compared with the debt holders, who take lower risk as compared with equity. Second, when we buy equity, we cannot ask for the money back from the company. However, in the case of debt, we can ask the money back from the company. This is another difference between equity and debt. Third, there is no fixed dividend for equity. The dividend depends upon the board and the profit of the company. However, when we take debt, we should pay the interest whether there is profit or no profit. This is another difference between equity and debt. Finally, when we take debt, we should give security as a collateral. However, in the case of equity, security is not required. All these factors will lead to the equity having higher risk takers as compared with the debt, and that is why they expect higher return. The definition, which I always discussed as assets minus liabilities, gives equity. Equity has 4 different components. 1. Share capital or premium. 2. Reserves and surplus. 3. Retained earnings. 4. Any other kind of accumulated income. The total of all these components will lead to equity. This is also called shareholders' equity, which is the equity plus reserves and surpluses, and retained earnings kept in the business for the growth and development. As said earlier, equity basically belongs to the shareholders, who are the owners of the company. It is very simple. Equity can be obtained by deducting total assets from the liabilities. Preferred stock. These are the stocks, which are different from the equity shares. Basically, there are 2 kinds of shares, namely common stock and preferred stock. The difference between common stock and preferred stock is that in preferred stock, they have priority over the common stock. For instance, during liquidation, preferred stock gets the money back first, as compared with common stock. That is, the preferred stock gets the money back first and then the common stock. This is the first difference. Second, the preferred stock includes the people who get fixed dividend. They do not get unlimited dividend, but the common stock shareholders may get unlimited dividend. Third, the value of the preferred stock is limited to the face value or redeemable value. Let us say the company issued the first stock for 10 years, and then again after 10 years or 5 years. We will buy the stock for 15 years. This is the maximum face value we can get. In the case of equity, let us say we invest $10, and after 5 years, if the company becomes a $5 billion company, we may get the value of 10 shares, or the $10 might become $100, $200, $500, or $100,000. It can be any value of the company. This is a difference. An important factor is that the preferred stocks are limited upside, whereas the common stock has unlimited upside. Another important factor is that the preferred stakeholders do not have voting rights, while the common stakeholders have voting rights. Generally, in many countries, the common stocks are also called as equity shares, and the preferred stocks are called preference shares, or preferred shares. The next concept is retained earnings. Let us say that you make profits of $100 in the business and do not pay the dividend. Instead, you keep this money in the business so that you can use it to grow. As you have not taken dividend and have reinvested the money, this is called the undistributed income, or retained earnings, because you want the company to grow, instead of taking dividend out and investing again as equity. You keep it as retained earnings, and hence this is considered as part of equity. Finally, the reserve account. Basically, you set up a specific fund to meet the specific need, which could be fixed asset or repayment of some kind of liabilities. As you are starting business and need money to grow and expand, the profit could have used for dividend and then reinvested in the business as equity. It is considered as part of equity. This is it from my side, friends. I hope you've enjoyed this session. I will see you soon in the next video. In the meantime, have a nice day and see you soon.